Before we start, consider this for a second. Some of the biggest wealth-building moments in history did not feel exciting when they began. They felt scary. They felt uncertain. They felt like the worst possible time to act. And that's exactly why most people miss them. What if the next life-changing money shift is already happening, quietly, in plain sight, while most people are still too distracted to see it? Most people think the biggest money-making moments look obvious while they're happening. They don't. In real time, they usually feel ugly. They feel uncomfortable. They feel dangerous. In 2009, the people buying stocks looked reckless, not brilliant. The headlines were apocalyptic. Retirement accounts were crushed. Banks were failing. Housing was imploding. And anyone putting fresh money into the market looked, to a lot of people, like they had completely lost their mind. But 17 years later, many of those same people are quietly millionaires. And right now, a shift that could be even bigger may already be underway. Not because the market crashed the way it did back then, but because an enormous amount of money is starting to move through the economy in a way most people still haven't fully noticed. Cerulli Associates estimates that roughly $124 trillion will transfer through 2048, with about $105 trillion expected to go to heirs and around $18 trillion to charity. The day everything looked like disaster. To understand why that matters, go back to one specific day, March 9, 2009. The S&P 500 closed at 676.53, its crisis low during the global financial meltdown. Lehman Brothers had already collapsed the previous year. Credit markets were in chaos. People were watching home values fall, jobs disappear, and decades of financial certainty evaporate in front of them. The dominant feeling was not optimism. It was fear. Deep, rational, human fear. Most people reacted exactly the way people usually react in moments like that. They froze. They waited. They moved to cash. They told themselves they would invest later once things looked safer. But safer usually means more expensive. That's the part almost nobody sees while it's happening. Imagine a school teacher named Margaret. She had saved $50,000 for a house down payment. At exactly the moment when the world seemed to be telling her not to touch the market, she invested that money into a plain S&P 500 index fund. No stock-picking genius, no insider information, no perfect timing strategy. Just a decision to buy broad ownership in American business when fear had driven prices down. If you roughly track the index from that 2009 low to the level it reached in early 2026, her money would have multiplied dramatically. That is the kind of move that looks insane in the moment and obvious only in hindsight. Reuters reported that the S&P 500 briefly crossed 7,000 intraday on January 28, 2026, meaning the index had risen more than tenfold from that 2009 low before intraday highs are adjusted for dividends, fees, or taxes. What wealth creation really feels like. That is what most wealth creation moments actually feel like when you are living through them. They do not announce themselves politely. They do not arrive with certainty. They usually arrive disguised as chaos, discomfort, or doubt. And the people who benefit most are rarely the ones with the best predictions. More often, they are the ones who keep participating, while everyone else is emotionally stepping away. The period after 2009 turned into one of the most powerful wealth-building runs in modern U.S. history. In 2010, the United States had about 8.4 million millionaire households. By the end of 2024, that figure had climbed to nearly 24 million. UBS said the U.S. added more than 379,000 new millionaires in 2024 alone, more than 1,000 per day, and that the U.S. accounted for almost 40% of global millionaires. That is a staggering amount of wealth creation, and most of it did not come from startup exits or lottery ticket stock picks. It came from long-term asset ownership. It came from markets rising while ordinary people kept contributing to retirement plans, brokerage accounts, and diversified funds. That matters because the story most people tell themselves about becoming wealthy is usually too dramatic. They imagine some huge breakthrough, a viral company sale, a lucky trade, or a perfect real estate flip. But the last big wave of new millionaires was built much more quietly. Teachers, nurses, engineers, small business owners, employees with automatic 401k deductions, couples who kept investing through volatility, people who were never the loudest person in the room but who kept buying assets while time did the heavy lifting. The real story behind the Great Wealth Transfer. And that brings us to what may be unfolding now. The Great Wealth Transfer is not just a story about rich families passing money to their children. That's the surface-level version. The deeper story is about what happens when that much capital begins moving through an economy. Money does not sit still. It gets reinvested. It gets spent. It gets reallocated. It gets moved into stocks, private businesses, real estate, trusts, philanthropy, and entirely new sectors that previous generations did not favor. That is where the real opportunity starts. Here's the first reveal, and it matters more than most people realize. Most people will not get rich from inheritance itself. They'll get rich from what inherited money does to everything around them. Cerulli's own breakdown shows that over half of the total transfer volume, about $62 trillion, will come from high net worth and ultra-high net worth households, even though those households represent only about 2% of all households. That means the largest inheritances are concentrated. Most people are not going to wake up one day and receive a life-changing fortune. But that does not mean they're shut out of the opportunity. It means the opportunity is more indirect, and in some ways more widely available than people think. When trillions of dollars move, asset prices can be affected. Investment preferences can change. Housing demand can shift. Industries that help manage wealth can expand. New business formation can accelerate. Existing businesses can receive more capital. Financial firms adapt. Advisory firms grow. Estate planning, trust administration, tax strategy, and wealth management all become bigger parts of the economic landscape. So even if you inherit nothing, you can still benefit if you own appreciating assets, work in sectors tied to wealth movement, or simply stay invested while that capital flows through the system. Why investor psychology decides so much. And this is where investor psychology becomes incredibly important. Wealth creation periods rarely feel like clean upward escalators. They feel noisy. After 2009, there was always another reason to panic. European debt fears, U.S. political dysfunction, trade war headlines, a global pandemic, the 2022 bear market. Constant reasons to believe the run was over. Yet the broad trend kept moving upward over time. That pattern matters, because some of the best days in the stock market often occur close to some of the worst days. Goldman Sachs has long highlighted how missing just a small number of top-performing days can significantly damage long-term returns. The practical lesson is not that volatility disappears. It is that reacting emotionally to volatility can become very expensive. Where the money may flow next, and younger investors may shape where a lot of this newly moving money goes. Bank of America's 2024 private bank study found that 72% of investors ages 21 to 43 said they believe it is no longer possible to achieve above-average returns by investing solely in traditional stocks and bonds. The same study showed younger, wealthy investors held lower allocations to traditional stocks and bonds, higher allocations to alternatives, and stronger interest in areas like private equity, real estate, and crypto than older investors. Whether someone agrees with those preferences or not, the important point is that capital often follows belief. And when an entire generation thinks differently about where growth will come from, trillions can start flowing into new places over long periods. That could mean more capital chasing artificial intelligence infrastructure, more money flowing toward clean energy and electrification, more demand for healthcare innovation as populations age, more investor attention on private markets, digital financial systems, and sectors aligned with younger demographics. It does not mean traditional index investing stops working. It means broad market exposure may still be the foundation, while certain areas could receive stronger tailwinds because of where new wealth holders want to allocate capital. Why housing may show it first, and the housing market may be one of the clearest places this shows up. Some people will inherit homes. Others will inherit financial assets and decide to buy homes. Some families will sell inherited property, increasing supply in certain regions. Other families will hold, upgrade, or relocate. Areas with aging populations may see more estate-related inventory come online. Areas attracting younger workers, higher wages, and technology investment may see stronger demand. So geography may matter more than many people realize. Not every housing market will respond the same way to the wealth transfer. In some places, it may soften supply constraints. In others, it may intensify competition. The boring strategy that still wins. Now here's the key shift in perspective. The best strategy for most people is still not complicated. It is still boring in the most profitable way. The last big wealth wave rewarded people who stayed invested in diversified assets over long periods. This one is likely to do the same. If you already own broad market index funds, retirement accounts, or productive long-term assets, you are not standing outside the system. You are already in the stream. The job is not to become a fortune teller. The job is to keep participating intelligently. Think about the math. A person who invested $500 per month into a diversified index fund for 25 years at roughly a 10% annualized return could end up with around $650,000 to $700,000 depending on timing and exact assumptions. Double that contribution to $1,000 per month over the same period, and the outcome can move into the $1.3 million range. That is not fantasy math. That is what compounding does when it gets enough time. And if an economy is being quietly supported by decades of wealth movement, capital reallocation, and long-term asset demand, those kinds of outcomes become more plausible for more people, not because the laws of money changed, but because the backdrop becomes more favorable. The real risk most people miss. That leads to the second reveal. The biggest mistake is not missing an inheritance. It's spending the next 20 years uninvested while trillions move past you. That is the hidden risk. Not that you fail to receive a giant check from a relative, but that you sit on the sidelines while one of the largest capital shifts in history reshapes markets, industries, and asset prices around you. 5 smart moves from here. So what should a regular person actually do with this information? Start with 5 moves. First, keep broad market exposure. Own diversified index funds so you participate in growth across sectors instead of trying to guess every winner. Second, automate monthly investing. Automation removes emotion, and emotion is where a lot of wealth-building plans go to die. Third, use tax-advantaged accounts as much as possible. Retirement accounts exist for a reason. Compounding works better when annual tax drag is reduced. Fourth, maintain a liquidity buffer. Cash reserves are not just for safety. They create optionality. They let you keep investing or even buy more when markets get ugly. Fifth, build skills that benefit from capital movement. If trillions are going to move through families, institutions, and markets, then fields tied to planning, real estate, advisory work, tax strategy, legal structuring, and asset management are likely to remain important and possibly grow. Even if you think this doesn't apply to you, and this matters even if you feel late, even if your income is average, even if you think wealth transfers only benefit rich families, even if nobody in your family is handing down money. History shows that major wealth creation eras still produce opportunity for people who simply own productive assets while the economy expands. The post-war housing boom did that. The long run from the early 1980s did that. The recovery after 2009 did that. The people who benefited most were often not the most dramatic. They were the most consistent. The question that really matters, that is why this moment deserves attention, not hype, not blind optimism, attention. Because once you understand the mechanism, the story changes. This is not just some rich people will inherit money. It is a massive amount of capital is going to move through the economy for decades, and that movement is likely to create winners far beyond the families receiving the transfer. And no, that does not mean every asset goes up in a straight line. It does not mean every sector wins equally. It does not mean valuations stop mattering or risk disappears. It means the background conditions for wealth creation may be stronger than many people realize, especially for people who remain diversified, disciplined, and patient. Back in 2009, the opportunity did not feel like opportunity. It felt like danger. That is why so many people missed it. They were waiting for confidence before acting. But confidence usually shows up after prices already moved. This period may end up feeling similar. not identical, but similar in one crucial way. The people who benefit most may not be the people with the flashiest predictions. They may be the people who recognize that a huge long-term shift is already underway and choose to position themselves while most others are still distracted by the next headline. So here's the question that really matters. When people look back at this era 10 or 20 years from now, will this be remembered as one of those periods when ordinary people quietly built life-changing wealth? The data suggests that possibility is very real. Cerulli sees $124 trillion moving through 2048. UBS says the US is still creating new millionaires at an astonishing pace. Bank of America's research suggests younger investors are already preparing to allocate wealth differently than the generation before them. Those are not random signals. They point to a system in motion. And the next chapter may not belong to the loudest people online. It may belong to the people who quietly keep buying, keep learning, keep building, and keep owning productive assets while this transfer unfolds in plain sight. If that's you, this story is not just interesting, it's personal. And if you also want more videos that break down the hidden shifts shaping money, investing, and financial behavior, without the hype, without the fluff, and without pretending wealth is built overnight, subscribe now. Because the people who understand these shifts early usually make better decisions long before everyone else realizes what's happening. If this video helped you see the bigger picture a little more clearly, stay with the channel. I make videos like this to help ordinary people think more calmly, invest more wisely, and understand the hidden forces shaping their financial future. Subscribe if that kind of perspective is useful to you, and I'll see you in the next one. Thanks for watching.